In this video, we're going to talk about Pershing Square Tontine, trading under the symbol PSTH. The stock has been receiving a lot of downward pressure lately, and many people were wondering if the company is still worth a shot. And that's what we're going to talk about today in this video, so please keep watching till the end. Pershing Square is a SPAC founded by the billionaire fund manager Bill Ackman as a venture capital vehicle during the hype of the SPACs. It was one of the most high-profile SPACs that was created back in 2020 because it managed to attract $12 billion of funding for Ackman to find a home run target. So far, he hasn't been able to find one, and that's the most important reason why the stock has been under a huge amount of pressure lately. So, what have we learned from this experience? First of all, investors who bought in the SPAC stocks are generally impatient and want to pocket rapid gains. We can see that tendency in pretty much the entire period covering late February to April. In the meantime, the big institutional investors mostly kept their positions where they were. There were not the majority of people buying in SPACs, as far as I know, so this is probably why the prices still ended up going downhill. This may be an important opportunity for those of us who are willing to wait it out, because the stock market being a zero-sum game, other people's losses now can be your gains in the future. Oh, and by the way, just a quick tangent here. The reason why some of those institutional investors are willing to wait for sometimes years with heavy losses before the stock takes off is because they may have invested like less than 0.1% of their money in some of those growth stocks. I think we should consider this when we invest in stocks as well, because that's how they're supposed to be, a random shot in the dark. When you have 1,000 different darts shooting in the dark, but in different directions, it's going to be much better than 1,000 darts shooting the same direction, hoping to hit some target. Alright, so the second thing to realize is that it kind of proves my point regarding the fact that as long as the SPAC doesn't announce a merger target, they will benefit from a floor price that corresponds to whatever price they initially sold the shares for. This layer of protection will be there as long as there is no merger announcement. So before I continue on, I just want to say that what I'm about to say next doesn't have any sort of scientific proof, but it is my speculation about the senior manager's psyche as far as SPACs go. So please just take it as a possibility. It's not something that I know for sure. We all know that SPACs are essentially publicly traded slice of venture capital funds. A piece of VC that people behind this company would have to give back to shareholders if they don't manage to secure a merger target at some point. I'm sure that they don't want to do this. On the other hand, they may not want to just merge with anyone either, because not only that may damage the founder's reputation in the financial world, it may also tank the stock price, because investors may not find this company interesting enough. So my guess is, with a SPAC that reportedly has the most funding in SPAC history, it's probably going to manage to find a rather large and high-profile merger. At that point, all bets would be off. They would try their best, but if the company they want to merge with is actually attractive to investors, then yes, that piece of news is obviously going to push the SPAC price to the sky. But here's the thing. If investors are not happy with the merger company, Pershing Square will probably still go with it, because between giving back the money and getting Bill Ackman's reputation tainted a little bit, they would probably choose to keep the $12 billion of funding. That's why I think that Pershing is eventually going to find a target to merge with, and once they announce it, it would be a decent moment to actually liquidate most of your position. I think that traditionally, venture capitals invest in things that are flashy and that they know can be a good story to tell in the stock market. Once they go public, who knows how long it's going to take before those companies can become profitable. Maybe 5 years, maybe a decade, like it was the case for Tesla. And what I know for sure is that for many of those companies, most of their initial investors don't want to stick till the end. Like, just imagine how Tesla was back in 2018 and 2019. But the thing is, they would wash their hands off this company once the merger is complete, because that's mission accomplished as far as they are concerned. So if you want to invest in the company's long-term potential, I would suggest you to calculate how much you want to put in this trade based on how much profit you pocket when selling a portion of the position, and pretty much just keep a position that is already paid by the profit from selling the majority of the position. In other words, you only keep in the shares of Pershing in that is made up the profit of your trade. From a price action perspective, Pershing's price is sufficiently low for most investors to build a position now. I think that a premium can be considered as reasonable. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.